Hey guys, welcome back to the channel. In this video we're going to be looking at the best performing ETFs in 2021. It's been a glorious year to be a passive investor in the markets, as each of these funds have delivered amazing returns to investors. I purposely didn't include any actively managed ETFs on the list. Each of the ETFs on this list are good old-fashioned low-cost index funds. 2 are based in the US and 2 are based in Australia. But all 4 of them are listed on the ASX and they're all available to buy just like any other regular Australian shares. If you enjoyed the video, please consider hitting that like button and subscribing to the channel. So let's get into the video. The first ETF we'll be combing through is the BetaShares Nasdaq 100 ETF with the ticker symbol NDQ. This is by far the best performing index fund on the list, as it achieved a massive 34% return this year. That level of return from a broad market index is pretty insane. It was mainly driven by the big tech companies in the top 10 that had an amazing year, like Tesla, Microsoft, Nvidia and Facebook. I did own this ETF for most of the year, but I ended up selling around 3 or 4 months ago to buy more Tesla and Corsair stock when their prices crashed. I recently had a change in strategy where instead of splitting my money 60-40 between individual stocks and ETFs, I decided to go 100% into individual stocks. I'll know in a few years whether this was the right decision or not. With that said, if I had to buy just one index fund to buy and hold for the rest of my life, then NDQ would probably be the ETF I'd buy. It currently holds all of the best companies in the world today. Companies that will likely continue to dominate the world for the next few decades. The top 10 holdings include Apple, Microsoft, Amazon, Tesla, Nvidia, Google, Facebook and Netflix. And just the top 5 companies take up 40% of the fund's weighting. And last but not least, for the fees, they charge a nice low fee of 0.48% per year, which makes them one of the top ETFs on the ASX today. The next ETF on our list is the Vanguard Australian Small Companies ETF with the ticker symbol VSTO. This is an index fund from Vanguard that tracks the smaller companies in the ASX. This ETF also had a great run in 2021, achieving a total return of 31.5%, a whisker behind the NDQ. Despite the close results, they couldn't be more different in terms of weighting and holdings. The highest allocation a single stock takes up of the total portfolio is 2.1%, and the top 5 make up just 9.4% compared to 40% for the Nasdaq ETF. If we have a gaze at the holdings, we can see most of the holdings are small cap businesses, or businesses with a market cap of less than 2 billion. Usually, though this isn't always the case, smaller companies make bigger moves than large companies, either up or down. So it makes sense that in a huge bull market, the small caps usually do very well and achieve fantastic results. And they'll probably continue to do well if we stay in a bull market for a few more years. Because it's a Vanguard ETF, we can expect really low management fees, and if we take a look, we can see they're just 0.3% per year. So overall, this ETF had a fantastic year in 2021, achieving a 30% return. I just don't know if those results are sustainable, because if we take a look at the earnings growth for the entire portfolio, the earnings growth is only 5% per year. So I wouldn't buy this ETF expecting 25+% a year, but as a long-term buy and hold, it's one of the best performing Australian ETFs. Next up, we have one of the most popular ETFs in the world today, and that is the mighty BlackRock S&P 500 ETF with the ticker symbol IVV. This has been one of the best performing index funds for a long time, and this year was no different. So far in 2021, this ETF has achieved a massive 30% return. Like the NDQ, this was mainly from the massive run by big tech this year. There's a lot of people saying we're due for a market crash soon and that we're in a bubble, but nobody knows when that's going to happen. If you're a long-term investor and you're not picking your own stocks, you're better off just buying shares of IVV every few months and holding it for 20 years. And that's exactly what Warren Buffett says most people should do. Just periodically invest in a low-cost index fund like the S&P 500 and hold it for many years.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field.
And finally, if we take a look at the fees for BlackRock, their management fees are ridiculously low at 0.03% a year. So all in all, IVV is one of the greatest and most popular ETFs for a reason. It's the fund Warren Buffett recommends, and it's the fund most stock pickers like myself benchmark their portfolios against to compare their performance. It holds the biggest 500 companies in America and is probably going to continue doing well for many years. Okay, last but not least, the final ETF on our list is the VanEck ASX Mid Cap ETF with the ticker symbol MVE. This ETF is comprised of the largest businesses in the ASX 100, excluding the largest 50. So if you had all the largest companies in the ASX numbered 1 to 100, this ETF owns numbers 50 to 100 and ignores the largest 50. This is an interesting strategy because you get the benefits of smaller companies making bigger moves, but you also have the stability of owning larger businesses in the ASX. If we have a quick look at the holdings, they own some household names like Seek, BlueScope Steel, Domino's Pizza and Reese. And in 2021 they achieved a 26% return. Like VSO, this was mainly driven by the massive bull market we're currently in, and the smaller companies reaping the benefits slightly more than the mega caps. If I had to choose an Australian ETF for the long term, I would probably choose a mid cap or small cap ETF over a mega cap Aussie ETF, but that's just my personal preference. And finally, if we look at the fees for MVE, VanEck charged 0.45% per year, which is nice and cheap. It really was an amazing run for index funds this year. 30% return in 12 months doesn't happen very often, but after the market crash last year and with all the money printing happening combined with low interest rates and crappy bond yields, it makes sense that the market is on a tear right now. I don't know if the market will hit 30% again next year, but if I had to guess, unless something dramatic happens on a macro level, I think the market will probably do okay next year too. Now, I could be completely wrong and the market could crash by 50% next year. I have no idea. Predicting the market in the short term is impossible. But according to Warren Buffett, if you just periodically invest in a low cost index fund and hold it for a long time, you're more than likely going to do very well, as long as the markets keep acting like they have for the last 100 years. My strategy is a little bit different. I had a bit of a change in strategy a few months ago and I decided to sell all of my index funds and put 100% of my money into active investing. I thought long and hard about it, but I decided I wanted to concentrate my portfolio into a very small number of businesses and hold them for a very long time period. It's a bit more aggressive than my previous strategy, which was 60% in individual stocks and 40% in ETFs. But in order to achieve the annual return I'm aiming for, which is 20% a year, I wanted to concentrate my portfolio into the businesses that I have the highest conviction in. So right now I only hold 4 stocks, which are Tesla, AMD, Corsair and Alibaba. And I have a tiny bit of money in Bitcoin and ARK ETFs as well. But over 90% of my capital is in those 4 businesses. I'd say my style is around 50% Nick Sleep and 50% Warren Buffett. But there's so many great minds that influence my own investing philosophy, like Charlie Munger, Monish Pabrai, Phil Town and Aswat Damodaran, just to name a few. If picking individual stocks isn't your thing and you want to take a more passive approach to investing, as Buffett famously repeats year in year out, just buy the S&P 500 and get rich bit by bit. If you're new to investing and you want to actually know how to buy an ETF, I made a full video where I show you step by step how to set up an online brokerage and how to buy your first ETF. So I'll put that video up in the corner here. If you've enjoyed the video so far, please consider hitting that like button as it really helps support the channel. And if you want to see more videos like this one, you can also subscribe to the channel. I release videos every fortnight and I cover all aspects of investing. If you have any questions about anything I said, or if you want me to cover a topic in another video, let me know in the comments down below. I reply to every single comment. Thanks a million for watching the video all the way to the end. And if you're still not satisfied, I'll put a link to another video in the corner that I think you'll find interesting. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. Thank you so much for watching. I really appreciate your support and I'll see you guys in the next one.